going to be a very important video because all you've been seeing and hearing for the last week and a half has been about the bank system collapsing. And there's a lot of different things you're hearing. So we wanted to spend some time really going in on what this currently means and what the impact of this moving forward could be. So why don't we start with talking about, I don't want to call it mess, let's call it the situation we're in. What got us here? When I try to simplify, we know it's going to be complex.
Yeah, okay, so what got us here? Give me a second to try and compile this in my head. How deep do you want me to go? Pretty surface level?
Let's start with this. Would you say that a lot of this happened because of the response to COVID, or would you say that this was actually happening before COVID? Because if we're talking about from COVID on, you can make the argument that, supply chain and, us, creating a ton of money created this situation of massive inflation, or inflation at a much higher rate than we want. And because of that, we saw the Fed basically start raising interest rates, which put a lot of these banks into a challenge.
Yeah, I mean, you could go all the way back to the financial crisis is probably the where you would have to go back to if you wanted to do a comprehensive answer, and talk about how during the financial crisis we started a comprehensive reform of the banking regulations, and we were probably too loose on the bank regulations prior to that, and so you ended up with the financial crisis as a consequence. Well, banks started looking at things like Dodd-Frank and Basel III and other regulations on how they manage their capital at the same time as you had a interest rate environment that was pushing interest rates very, very low. And we saw, between financial crisis and 2020, things stabilized, interest rates started to tick back up again. But then almost immediately, they ended up crashing back down with COVID, going back to near zero interest rates. And so you have the regulatory environment that's requiring banks to take reserves against the investments that they make, having to do risk-based testing and other things that were targeted at making them be more careful in how they lend. And then you combine that with very low interest rates, making it to where banks couldn't really make any money on the deposits that were coming in. All of that kind of contributed to the decisions that banks were making during the COVID and post-COVID environment that led us to where we are today.
Okay, so it started with Silicon Valley Bank. And, a lot of what was coming out was this was a unique kind of niche bank that really focused on the tech community. And because of that, they were experiencing, what ultimately led to, run on the bank. But then we started seeing banks follow, Signature and then First Republic that aren't focused on tech. They're, more of a, what would you call it? Not conventional, but they kind of fit the more norm in a sense. Was there something specific to SVP, or was that just the beginning of what we were about to see play out?
Yes, yes to both questions. So, why SVB was the first to fall? There were some attributes that are unique to SVB, and the nature of their business being very heavily weighted towards these tech companies that were private equity backed. You saw their deposit base grow dramatically while private equity funds were investing aggressively. And then when the Fed started raising interest rates, all of a sudden, private equity funds start pulling back on funding their companies. And so you had this massive swell of deposits going into SVB that they had to do something with. And then all of a sudden, they shut off the tap, and these companies go from being net depositors to net withdrawers. And then at the first sign of trouble, these private equity firms, they pay pretty close attention to what's going on with their companies. And so first indication that SVB might not be completely safe, and those private equity firms started calling up their companies saying, hey, maybe move away from SVB, reduce your risk exposure there. And SVB saw tens of billions of dollars walk out the door in a 2-day period. That'll kill any bank.
Okay, so then now move into Signature and First Republic, and probably what we're going to see is more to come. What happened there?
Well, Signature, it basically had a business model that resembled SVB, and so as soon as one bank falls, all of us who are watching that business, recognize that it's a table of dominoes. When one goes, you're immediately looking for, okay, who's next? And in the absence of good information, you just start looking for, okay, well, who else looks like that bank? And of course, Signature, fit that bill. First Republic also had some similarities in that as soon as it kind of came to light what drove SVB's fall, being these unrealized losses on their bond portfolio, First Republic, has that attribute as well. And so you had, your ratings agencies and everybody else paying real close attention to all of that. And as that information has come out, it spills over.
How does this, at least what we're starting to see play out, how does this look different than, what we call the bailouts in 2007? Are the banks today getting bailed out, or does it look different?
It looks different. I suppose you could still call them bailouts, but the big difference, of course, the politics of bank bailouts are really bad. Politicians are all about getting reelected. Right. No offense.
I hear you.
But so nobody wants to be the one promoting bank bailouts, and right now. So what they're trying to do is posture as we're not bailing out the banks, we're bailing out the depositors. And they're not wanting to use the word bailouts. They're just protecting your deposit accounts. And that's probably the right thing to do. The people who led the banks in these decisions need to be held accountable for that in some fashion. If nothing else, at least they should be losing their jobs over it. And so what they've been doing so far, seems to be going that direction. The depositors, on the other hand, unless you want the entire system to collapse, you want depositors to feel like the system is safe and reliable, and you don't want everybody pulling all their money out of the banks all at once, because again, banks just aren't built that way. Okay,
so now that we're seeing that FDIC is going to insure, in some of these instances more than the $250,000 per depositor, is that what we're going to see for all banks? Are we going to see this, any dollar you have in will be insured always, or is it only a certain amount that get that protection?
Boy, that's a good question. If you know the answer to that one, you could make some money off that knowledge. Two ways to look at it, and they're in conflict. So on the one hand, you have people who are saying, well, this is the beginning of the nationalization of the bank system. And most of us would view that as a bad thing. So the federal government getting too involved in what banks are doing and how their financials are run and all of that could be bad for a lot of reasons. And of course, there's all kinds of conspiracy theories going on social media about how the government wants to nationalize the banking system and things like that. So on the one hand, FDIC insurance going too far potentially gets the government more involved in the banking system than we want. On the other hand, you still have that whole depositor confidence issue. If depositors can't be confident in their banks, then of course they want to reduce their risk exposure to the banks, and what that means is pulling money out and tip the dominoes. They all fall in that scenario. And so the entire banking system is built on trust, on the expectation that if I put my dollar into the bank, it's going to be there when I need it. I don't have to worry about, is the bank going to still exist? It's just, I put the dollar in, I get it out. And with that kind of confidence, the banking system can work very, very well, and you have an entire economy built on reliance on the banks. But as you know, the banks, they don't take your money and put it in a vault. They can't do that. The way that they make money is by lending that money back out. And, well, two ways. One, by lending the money out, and second, by paying fees. So the vast majority of their income comes from what they call their net interest margin, or the difference between the interest that they earn on the loans they make versus the interest they have to pay on the deposit accounts. And they are running very large organizations with a whole lot of staffing to try and comply with all the regulations and make sure that all their accounting is in order and all of that stuff. It's not like there's just one guy there and low expense ratio. These banks are big organizations that require a lot of labor to operate. So they have to put that money back out to generate that interest in order to cover their operating expenses and hopefully deliver a profit to their shareholders so they can keep growing. So when they do that, if they put that money back out in a loan, they don't have the ability to just, call the loan and say, hey, pay me back today. John needs his money back. Right. When they make a loan, they've got to put it out there for a period of time. It's in your mortgage or, a commercial loan to a company that needs to go buy equipment or something like that. So they're going to get paid back at specified periods in the future. So if all of a sudden all the depositors come in and say, hey, we all want our money back, they can't get it without foreclosing on all of these loans first, and then of course that takes time, and so the whole system just crashes down.
So one thing we heard Janet Yellen say is how they're going about picking what banks the FDIC will come in and insure beyond the $250,000 for each depositor. And somebody that she was talking with made the case that they're incentivizing big banks and ultimately depositors that might be putting their money in some of these community or regional banks. Why would they put dollars here when you're incentivizing them into the big banks? And is that the case? What do we do about that? Is that what's going to happen? Everybody's just going to put dollars where they know their total deposit is going to be insured?
First of all, recognize that the testimony that you're referring to, that's as of a moment in time.
Fair.
So if a couple of weeks ago when SVB was going through its issues, and then that Friday when they announced that, okay, FDIC stepped in and is taking over, first thing we were looking at is, okay, how does this not turn into another crisis? How does this, what does the Fed need to do in order to contain, the dominoes, if you will? And, one of the things that we talked about was, well, first thing they got to do is assure the depositors that their money is still there. And Friday afternoon when the FDIC said, okay, yeah, if you have under $250,000, we'll honor your deposits. Beyond that, we'll see. That was a scary moment. And of course, over the weekend, as you know, they reversed course on that because that immediately triggered not a run on the banks, but a run on a couple of banks. And that's probably a big part of why Signature Bank failed, and one or two others. So by Sunday afternoon, before the weekend was even over, they had already reversed course on that and said, okay, stop. We'll insure 100% of the deposits, and that was entirely targeted at trying to prevent people from wanting to withdraw their funds. They also addressed the second issue, and that's these longer dated securities, primarily U.S. Treasuries, that banks had been investing in to try and generate a little bit of that yield for their net interest margin, in what they thought was very safe, the safest even of investments that they could make. And so they created a lending facility that enabled banks to post those securities as collateral for loans from the Fed rather than having to sell those loans in the open market. And that was another big factor that I think maintained the integrity of the system. And it makes sense for the Fed to do that. I mean, they're basically it's the U.S. government saying, okay, you lent me money, I'll let you use my loan as collateral for me to lend back to you. That's not a high-risk position for the U.S. government to take, and so it was a sensible thing for them to do. So
I think the concern is always this one. Like a lot of times we see the government try to solve a problem and then a bigger problem is created because of it. That's ultimately what, there's always going to be cause effect. Is this effect?
Yeah, it's the unintended consequence that can be really, really hard to see with foresight. And sometimes, even as they're making these decisions, they know there's a risk of some of these consequences. It's just a relatively low probability, and it's the best answer we have at the moment, and so they set policy accordingly. And they keep on, of course, trying to refine that and improve upon it over time. But sometimes, those low probability events play out, and so here we are. But getting back to the question of Janet Yellen's response about how do they make these decisions, that's going to have to be dynamic. And so one of the things that we will see is we will see the Fed allow banks to fail. In the 1980s, we saw as the Volcker team was pressing interest rates higher to combat inflation, a lot of banks failed during that time, and they were okay with that. Okay with it is maybe the wrong word. They were willing to accept that as a consequence, and and they saw fighting against inflation as being relatively more important. I think that's true today as well, but within the context of the integrity of the banking system as a whole. So when it comes to these decisions, if they can allow a small bank to fail without it having an impact on the entire system, they'll do that, I think. And this, of course, is entirely speculation, so we won't know for sure until we have the benefit of hindsight. But that would be my guess. And that's just I don't know how you could possibly allow a bank to fail and allow depositors to lose their deposits at this moment in time without triggering a much bigger problem. And so I think in large part it depends on when it happens. If you have another bank failure right now, I think the Fed has to come forward and provide that additional insurance, or the FDIC has to, in order to preserve the integrity of the system. 2 years from now, maybe not. So I think it'll be something that's dynamic.
So when they made this decision that they were going to basically cover all of the depositors, you saw the Fed's balance sheet increase, right? But if we look over the last year and a half, the Fed has been tightening and raising interest rates to try to bring inflation down. And what they got to was about 6%. It's at the lowest so far. So are we now seeing a reversal of that? Is this move to back the banks going to be inflationary? And secondary, do you think we're going to see the Fed pivot because we may have gotten to a point where we're breaking things?
Okay, good question. So to start with on the answer, I think it's important to understand, real versus relative, when it comes to inflationary pressures. So let's go back to 2008 when the Fed started cutting interest rates and introducing, the TARP program and things like that, and all the different things that they were doing to, quote unquote, print money. And of course, everyone back then was saying, this is going to create all kinds of inflation and, doomsday scenarios over the disaster that printing money was going to create in light of inflation. Well, they were partly right. All of those things did create inflation. It's just they were creating creating inflation in a deflationary environment. So when you're starting at a negative, introducing a positive is the right thing to do. And so, creating inflation to combat deflation versus creating inflation in an inflationary environment. So it's important to note the distinction there. It gets a little bit more nuanced than that even in this scenario where, the direct answer, of course, has to be yes. Are they creating inflation by introducing this new lending program and creating liquidity? The default answer to that always has to be yes, that's an inflationary thing on a relative basis. But the context matters. And so if they are creating liquidity in the face of a liquidity crisis, that's probably still the right thing to do. That does not necessarily represent a pivot. And so I think that...
Let me change that.
Okay.
I should have asked them in two separate questions. The first one being, is what they're doing with the banks inflationary? Then the second question is, will we see a pivot because of what we're seeing in the banking industry? Meaning, instead of the Fed staying on this aggressive interest rate hike, will we see them ease off?
Too early to say. So right now, based on the information I have, I think it's too early for them to back off. I think that they need to continue being aggressive in their fight against inflation. With SVB failing and the concerns about the other banks, that's going to have economic impact. How much, we just don't know. And if they can prevent this from becoming a systemic issue where all the banks start to crash and all the banks tighten up and so on, then they'll have to continue fighting inflation very aggressively. And in that scenario, more 50 bip plus type rate hikes may very well be in the cards. Last inflation print was not positive. So you have inflation, even core inflation, still running higher than what they would like. And so the fight there still is going to be fairly nuanced for potentially an extended time. Having said that, that can change in a moment. If all of a sudden, the Fed decides to allow some significant banks to fail, and doing so they recognize is going to have meaningful, negative consequence for the economy, they may end up pivoting very quickly. So far, it looks like the direction that they're going is maintain the integrity of the banks, try and preserve them, while at the same time continuing to raise interest rates, push interest rates higher for the inflation fight. So similarities to the strategy that they deployed in the 80s of allowing some banks to fail, but this time doing so in a way where depositors are not harmed. And so, behaviorally, people, their confidence in the banking system is minimally compromised. I would like to say not compromised, but there's definitely some impact to bank failures. But they're trying to do it in a way where the, people maintain their confidence that the dollar I put in the bank is safe. And if they can do that, if they can navigate that successfully, that will likely be accompanied by continued interest rate hikes.
How does everything going on with the banking system impact everyday Americans? This is all they're seeing. How does this really impact them?
Yeah, good question. The big answer to that, at least in the short run, I think is psychological. So there's always the fear, that the unknown brings, and of course, it's scary for those of us who are watching it and understand it. Far more so, perhaps for people who are watching it and scratching their heads, going, "What's all this mean?" And can I trust my bank? And those kinds of questions. So right now, the impact is fairly, in terms of actual direct impact, very small. It's concentrated in a small number of companies and people that are affected by it directly. Mainly the people who are working for the banks and the people who provide services to the banks. But psychological impact, remains to be seen what that's going to be and what the second and third order effects are. So what do I mean by that? So right now we see a big trend, like you were saying, people withdrawing money from smaller banks, putting them into, putting funds into the four largest banks, and then, in return for all the largest banks going, well, shoot, what are we going to do with all this money now? And so they're putting it back on deposit with the mid-sized and smaller banks. How all of that is going to end up playing out, we'll have to kind of wait and see. But what we wrote to our clients here in the last week was the idea of being prudent. The probability that your bank fails and that you actually lose money in that, unless you are running a large business that has many millions of dollars on deposit at the bank. Most people don't have more than $250,000 sitting in a bank account, right? And if you do, there are things you can do there. I was talking with one of our banks, and they were talking about how they have a program where you can leave your money with the bank, and they will go out and redeposit it with other banks in $250,000 slices to make sure that your entire deposit, even if you're talking many millions of dollars, remains insured. And they'll do that for you in some cases. So you can have those kinds of conversations. Or if you're under that $250,000 limit, which I think most people are, it's just as simple as recognizing, okay, FDIC insurance means that I'm not going to lose the money, but it doesn't necessarily guarantee that my access to the money will be uninterrupted. There may be a brief moment or maybe even an extended moment where my access to that cash is limited. In the case of the SVB failure, the FDIC made a point of communicating that you have immediate access to all of the cash that was insured, and then of course backtracked on that and said, okay, immediate access to all of your cash. They're just not required to do that. Right. And so they probably will continue with that pattern while we're in the middle of this. So I don't see a reason for people to go into panic mode and go out and act now. But just as a general rule, it's a good idea to have some backup cash, either with a second bank or in a high-quality money market account, or something like that, so that if you're temporarily unable to access the money due to a bank failure, then that doesn't affect your ability to pay your bills. So that's really about all that needs to happen. Of course, if the Fed navigates this wrong and makes bad choices, any number of possible outcomes. But hopefully they've learned from past experiences, and everything that they're doing so far seems to indicate that they definitely have, and they seem to be doing, making smart moves as much as the politicians will allow them to do so.
Is there any concern for people who have a mortgage, and if their bank goes under because of that, or how does this affect people with mortgage?
We joke internally about how we want our lender to go bankrupt, as if that's going to make the debt disappear or something. Of course, it does not. If the bank that holds a loan on your property, or where you have a equipment loan, real estate loan, whatever the debt is, that's an asset to the bank. That loan represents an asset on the bank's balance sheet, and so. When that bank is taken over, either by another bank or by the FDIC, that stays on the balance sheet of the new bank. So you might be making your payments to a different lender, but that's about the only thing that changes.
So they don't have to worry about their loan being called due if that happens? Because technically...
Yeah, good question. And very good question.
Now we're freaking everyone out.
On consumer loans, generally, no. There's a lot of consumer protections built in that limit what banks and other lenders are allowed to do on your auto loans, your college loans, your mortgage loans. Commercial, on the other hand, business loans, that's a different thing. And so those loan documents are typically negotiated. They tend to be for much higher balances. And so, you typically, like when we're doing a loan on a commercial property, we have attorneys that represent us in the negotiation of those loan documents. And we always go through that negotiation with the understanding that the person who is enforcing those documents might be reading them for the first time. It might not be someone who values the relationship. And so that's an important thing. So depending on what the loan documents say, that'll determine what the new lender's rights are. In general, though, if you're a good borrower, if you've been performing, banks want you to continue performing. Banks don't want to own your property. That's bad, for a lot of reasons, from a bank's balance sheet and their liquidity management and all of that. When they have to go into foreclosure, that looks bad for them, and creates a lot of financial pressures on the bank. And so I'm not real worried about banks doing that on a malicious basis or even a reckless basis. Where you do need to be worried is if you're in a business that is suddenly becoming impaired. Okay, if you're seeing a significant reduction in your business in this economic environment, or if you have lines of credit that you haven't been using, those kinds of scenarios, I think that there's a very real possibility that you end up having a conversation with the bank. But for the average consumer, I don't think you're likely to run into any of those kinds of issues.
I hope that was helpful. Make sure you're checking in daily. We put out content each day, so we'll kind of keep everyone up to speed with everything that is happening. And then I'm sure with this one, there will be more long form videos like this to kind of go over in depth, maybe things that the Fed is now doing, or the government as it pertains to these banks. Thank you all for being here. If you're not subscribed or you don't follow us, make sure to do so. And we will see you guys next video.